Hello, and welcome to the Retire Stress Free podcast number 9. What is an annuity? And 10 things you need to know about annuities if you're considering buying an annuity. Well, first off, what's an annuity? Why buy an annuity? How does an annuity work? What are the different types of annuities and how do they differ? What are the number one reasons to buy an annuity? Are there any disadvantages of an annuity? What are the annuity payout options, and are they all the same or are they different? What happens when the annuity owner dies? How is taxation handled inside of an annuity, and who should buy an annuity? So let's start. What is an annuity? An annuity is a contract between an individual and an annuity provider, an insurance company. The individual makes a purchase payment, either in the form of a lump sum, which is known as a single premium, or in periodic payments, which are known as flexible premiums. The payments generally are referred to as deposits. The insurance company invests these deposits. The insurer eventually pays money to the individual. This money can be paid either in a lump sum or in a series of payments over time. In the classic annuity, also known as the single premium immediate annuity, the annuity provider pays a guaranteed amount every single month to the individual as long as that annuity holder lives, regardless of the length of time, even if they live to 150. If the annuity holder lives long time, many years, the payout will far exceed the amount invested up front. However, if an annuity holder dies prematurely, likely they could receive less than the amount invested in the annuity. It's one of the reasons why I don't like these annuities, but for some people it's a perfect solution. Let me provide a real-life example of an immediate annuity that turns words into numbers. Angela, a 65-year-old widow who was concerned about outliving her savings, buys an annuity from XYZ Insurance Company for $100,000. In exchange, the insurance company agrees to pay Angela in the amount of $440.43 per month for the rest of her life, starting immediately. This is probably the simplest annuity structure. It involves a single lump sum payment, pays out a fixed amount, starts immediately, and it pays for the rest of her life. There are different types of annuity we'll discuss later, but this was the earliest and simplest form. Angela lives till she's 97 years old and ends up receiving $169,125 for the rest of her life in exchange for a lump sum of $100,000. That was a really good deal. Now, why should you buy an annuity? The guaranteed payout feature is the most important reason why retirees invest in annuities. One of the greatest fears of retirees is that their savings are going to run out before they die, leaving them with just Social Security as their only source of guaranteed income. By investing some of their savings in an annuity, the annuity provider is guaranteeing that individual an additional monthly annuity check on top of Social Security. The retiree invests in an annuity, which is essentially buying financial peace of mind to enjoy retirement without financial stress. People typically buy annuities to help fund their retirement because it's a long-term financial strategy that can be used to guarantee income later in life. And remember, Social Security is nothing more than an annuity. Now, how does an annuity work? Well, when an individual purchases an annuity from an insurance company, it's the annuity provider, that person, who is called the annuitant, is transferring the risk of that money, that investment, to the insurance company. Similarly, other types of insurance, the buyer needs to pay the annuity company to bear this risk in exchange for the certainty of a guaranteed stream of annuity income into the future as long as they live. The annuity is usually paid for through a lump sum deposit, but also can be covered with a series of payments over time, and that depends on which annuity you buy. The period of time in which the annuitant is making payments and buying the annuity is called the accumulation phase. We talk about this in mountain climbing a little later. The insurance company invests the money that the annuitant has and pays throughout the accumulation phase, most often in stocks, bonds, and real estate. The annuity company uses the earnings from these investments to make these regular payouts to the annuity owners. The payments received by the annuitant from the annuity are usually structured as a periodic payment over time. Only rarely is a lump sum payment used. Unlike other types of insurance, you do not need to pay for an annuity indefinitely. Instead, you stop paying the annuity at the end of the accumulation phase, and then you start receiving the money or income in return. Once you start collecting payments from your annuity, you've entered into the annuity payout or distribution phase. So again, think of it like a mountain. Accumulation, distribution. Now, let's talk about the types of annuities. There are more types of annuities than just the immediate annuity we talked about in the example above. In addition, the immediate annuity and other types of annuities have a lot more flexibility than the one we just talked about. The choice of the annuity and the terms of the annuity can be structured to meet anybody's needs or preferences, which is why you need to talk to an expert, someone like me. First, the annuitant can decide when to start receiving these payments. An immediate annuity is one that begins paying you out as soon as it's bought. Alternatively, a deferred income annuity starts making payments in a predetermined date in the future. These are also called longevity annuities. Sometimes they're called qualified longevity annuity contracts or deferred annuities because they offer the annuitant the opportunity to generate income payments with a smaller deposit than an immediate annuity. Because the insurer will invest those deposits, earn returns from those investments before they ever begin the payout phase. Plus, the payout phase will be shorter than an immediate annuity. So again, talk to an expert and find out the best solution for you. The annuitant can also choose the terms of the income payments. We'll discuss this a little later. So again, during the accumulation phase, you're climbing the mountain, you're putting money in, there are three types of annuities you can choose from. These are generally called fixed, variable, or indexed annuities. The fixed annuity is kind of like a CD. It's like a fixed deferred annuity. It guarantees the safety of the principal you put in and guarantees a minimum rate of interest on that investment during the accumulation phase. The interest paid on the account is predetermined each year based upon market interest rates. Fixed annuities are predictable, they're safe, so the annuitant does not run the risk of losing any money. However, fixed annuities may provide a lower modest annual return, especially in times of low interest rates. The interest rate earned generally is much higher than what you get on a certificate of deposit. Plus, it's also tax deferred. Now, a variable annuity carries much higher, greater risk than a fixed annuity, and they have the potential to provide larger payouts because in a variable annuity, the deposits are usually invested in mutual fund-like investments that might be selected by the annuity owner or by the insurance company. The value of the annuity account changes over time based on the performance of the investments. The investments could rise or fall in value, so the choice of investments may cause the annuitant to either lose money or earn more than the possible fixed annuity. I do not sell variable annuities. I don't like them because you can lose money. Now, an indexed annuity will pay an annuitant a guaranteed minimum rate, usually that guarantees the principal's safety. Plus, an indexed annuity also provides the potential to earn higher interest rates based on the performance of an investment index. For example, the S&P 500, or a basket of market indexes. Index annuities fall between the fixed annuity and the variable annuity based on potential risk and reward. Now, what are the benefits of investing in annuity? Well, the biggest benefit, the most prominent benefit of owning an annuity is that the annuity holder is guaranteed a potential steady stream of lifetime income during the payout phase. They're also quite flexible because the contract with the annuity provider can be customized to fit an individual's very specific needs. For example, an annuitant can pay into it periodically or with a lump sum, and then can receive return payments monthly, quarterly, annually, or a lump sum. The annuitant can also decide exactly when to receive these payments, can manage how much risk to assume, and more importantly, annuities provide long-term income, if desired, that can either be flat or grow over time. The guaranteed income from an annuity also allows the annuitant to adopt a more aggressive investing strategy with their other investments, because the combination of an annuity, Social Security, and investments in the market mean the annuitant is assured a guaranteed level of retirement income no matter what. In addition to providing a steady stream of lifelong income, annuities also have the capability to fill other functions if an annuitant chooses to take advantage of their versatility. For example, an annuity can provide the annuitant with an option to create a legacy plan, because to preserve funds for future generations. In addition, taking care of future generations, the annuitant can choose the annuity to protect and preserve assets for a surviving spouse through death benefits to sustain a spouse's lifestyle, or enhanced benefits to help defray costs of long-term care. There's a lot of things you can do to customize your annuity. Now, yeah, there are some disadvantages to annuities that everybody should know about. Annuities are a very attractive retirement income solution, but they also have some drawbacks. Annuities can be associated with high fees. These fees may include some commissions, ongoing investment management fees, early withdrawal fees, and the level of fees depends on the type of annuity. Immediate annuity, fixed annuities, fixed indexed annuities have very low fees and expenses. Variable annuities can have very high fees and high expenses. The level depends on the annuity purchased and the features of that annuity. Additionally, some annuities are complex, can be a little difficult to understand. It's important for you, the investor, to understand your investment fully, and for some people that have struggled to grasp these things, you need to work with a professional like me. Plus, it's also vital to consider the financial standing of the annuity company before buying one. Annuities are not backed by the federal government. Rather, the payment guarantee comes from the insurance company. So the financial strength of the insurance company is very important. You need to consider it. You need to consider what states do the associations that are being offered are available, because each state determines coverage limits and is provided by an association or fund so that it doesn't run out of money. Now, what are the annuity payout options? There are 3 options to choose from when you are deciding how you would like to receive your annuity. These payments can be annual distribution, which is a structure called annuitization. So you can annuitize a contract, and that simply takes your money and provides income payments to the annuitant for the rest of their life, for a specific period of time. When the annuitant decides to use this method, the amount of money that will be received in each payment is determined by the insurance company based on the life expectancy or based on the period of time they wish to receive these payments. This is called annuitization. Less than 1% of annuity contracts are never annuitized because people lose control. They don't like it. Systematic withdrawal schedule is another payout option which provides a lot of flexibility. When this payment method is chosen, the annuity and the annuitant must specify how frequently they want to receive their payments and the amount of each payment. Funds are withdrawn from the annuity based on those decisions. With a systematic withdrawal schedule, one chooses to withdraw funds from the annuity until it runs out of money and it's empty, thus creating the risk that the annuity could run out of money before the annuitant dies. The final option is for the annuitant to receive a lump sum payment. A large lump sum is paid on one single payment and determined on a specific date. The lump sum payment most likely will be selected when the annuitant used a variable or indexed annuity during the accumulation phase, and they want to use a different annuity or a different option during the payout phase. Again, you have lots of flexibility and lots of choices. You can customize it to whatever you're wanting to accomplish your goals. What happens to the money when the annuitant dies? After the death of the annuity owner, the remaining annuity can be left to be inherited by a beneficiary or multiple beneficiaries. They have to be selected by the original owner, and the contract has to be negotiated between the annuitant and the insurer to include the death benefit provisions in which the annuitant can designate who that beneficiary is. Typically, the beneficiary is either a spouse, a child, or some other loved one. The beneficiary may receive all of the remaining money in the annuity or a guaranteed minimum that the insurance company may distribute to the beneficiary either in a lump sum or in a series of payments. If the annuitant doesn't pick a beneficiary, then the death benefit is paid to the annuitant's estate. Keep in mind that there are often no payments to a beneficiary when the annuitant chooses to have payments annuitized for life or joint life. When the initial payee or payee passes away, the income payments stop, which again, I don't like annuitization. There are better ways to get guaranteed income for life. Some annuities have payments to beneficiaries if the annuitant dies before reaching a life expectancy or before a minimum period of years. But with these annuities, the payments to the annuitant during his or her life will be lower for an annuity without this provision. So again, you got to structure it properly. I can help you do that. How are annuities taxed? Annuities are tax deferred, meaning the money invested in the annuity grows without being taxed until you reach the payout phase. You don't pay taxes on the earnings while they remain in the annuity. Huge advantage. Taxes must be paid when the money is withdrawn. The rate at which the withdrawals are taxed is dependent how the annuity is funded. If an annuity is funded with pre-tax or what's called non-qualified dollars, everything withdrawn will be taxed at the annuitant's ordinary income rate, and this is called the qualified annuity. These annuities are part of a retirement or pension plan. The post-tax dollars are used to pay for an annuity, making it a non-qualified annuity. The annuitant will not be taxed on a portion of withdrawal that represents the return of the original principal because you already paid taxes on that. Since non-qualified annuity is funded with earned income that's already been taxed, only the portion of the withdrawal that's considered earnings is taxable. Non-qualified annuities use a method called the exclusion ratio to determine how much of the withdrawal correlates to the principal investment and how much comes from earnings. The purpose of the exclusion ratio is to split payouts between taxable and non-taxable in an equitable manner. Again, talk to an expert. I can help you structure it properly so you're taking advantage of both ends of it. Who should buy an annuity? Generally, most people who buy an annuity are buying an annuity after they've maxed out other retirement plans like 401ks or IRAs because they offer tax deduction. If these more tax-efficient retirement saving options are maxed out and the money's been set aside, the tax-deferred growth provided by an annuity may be a great idea. An immediate annuity or a life payment option of annuity would not be an advantageous strategy for someone who has health problems that might make it unlikely for the individual to reach their life expectancy. A fixed deferred annuity or an index annuity or a variable annuity might be a great choice for a person during the accumulation phase to provide for a spouse or future generation. Someone who's healthy and desires a security of steady income they will not outlive may benefit from an annuity. However, the best use of annuity is to complement other retirement income sources and not to make an annuity the sole source of retirement income unless you have a small pot of money and that's all you've got. If an annuity isn't right for the annuitant, you can always get out of the annuity for free during what's called a free look period. This is the period of time when annuitants can receive a full refund of their contract. Free look periods vary by state and can range from 10 to 30 days. After that, the annuitant is generally locked into the annuity for a period of years and must pay a penalty, or what's called a surrender penalty, if they decide to pull all of their money out. But remember, every annuity also has a liquidity feature, which allows you to pull out typically 10% per year of that annuity principal, so you have some liquidity along the way. Now, that's an awful lot. There's an awful lot there about the different types of annuities, how and when you should buy an annuity, and the majority of the people that I speak to today are looking at an annuity for the guaranteed retirement income planning options they provide. Not the annuitization side of the equation, because I really don't like those because you lose control. But with a guaranteed retirement income plan, you can choose an annuity to grow your money, protect it until the day you start turning it on, and then you can have guaranteed retirement income for life. Not only for you, but for your spouse. And if you don't use all of it, unlike the single premium immediate annuity, there's money left over for either a spouse or a beneficiary. It truly is the best of both worlds. So, how do you find out which annuity is the best annuity for you? How do you find out even if you should buy an annuity and utilize an annuity in your retirement income plan? Well, two ways. One, pick up the phone and call me. You can call me on my cell anytime, 216-272-2333. Or text me. I'll text you back and schedule an appointment. And in the description of this video, there's going to be a link. You can click on the link and book a 15-minute introductory call with me at any time, and I'll answer all your questions. I'll help determine if an annuity is correct for you, and I have an educational approach, not a sales approach. So I'll provide a lot more information to you that's specifically customized to you and your needs. So if you want to retire stress-free, an annuity might be the best solution for you. Thank you.